Hi, you're at Real Turkey channel, and my name is Atilla Yesilada. Today, I'm going to try to answer the question of whether Turkey is facing another currency crisis. If you follow Turkey through international financial press, you won't see that question. There is basically no coverage of how shaky Turkey's financial system is. If you read investment bank reports, you would see concern, though it's not expressed as starkly as I've suggested. So, why am I covering this subject? Well, because that's the number one topic in Turkey's overexcitable and bombastic YouTube community. I take YouTube very seriously in Turkey because it's the only forum where there is some kind of freedom of speech where people can express their opinions. It's the only place where really ideas clash and the market, that's the viewer, decides what's going on. There indeed is a serious concern about financial instability. It was triggered by Erdogan's monumental mistake of ordering the arrest of his main rival, former CHP party Istanbul Mayor Ekrem İmamoğlu, after which the streets erupted in protest, which continue today. In the meantime, both Turks, who suddenly became very concerned about Turkey's political futures, and foreign investors fled Turkish lira assets. Foreign financial investors simply sold off and went to other countries, while Turkish depositors migrated from Turkish lira deposits to FX deposits. For the time being, the central bank has sufficient reserves to cover uh, both the current account deficit, FX demand coming from the remaining few foreign financial investors, and some retail demand. But obviously, no country except the United States or other reserve money countries can withstand a sustained attack on the domestic currency. That leads to a currency crisis or a balance of payments crisis, and then the economy crashes. So let's put this situation at the table and to ask the question whether these outflows from Turkish lira assets will continue. I'm going to suggest that the political outlook is not going to matter much in this respect, but the central bank's upcoming rate decision this Thursday on 17th of April is going to be hugely important. According to polls, central bank is not expected to cut rates, which should stem the panic and slow down or stop the migration of retailers from Turkish lira deposits to FX. If it makes the mistakes of cutting, we're looking at a very troublesome summer. It could also raise rates. So let's first do a post-mortem on why there was such a sudden flight from Turkey and from Turkish lira assets, and then answer the question of why it's very costly to stay in FX deposits and how central bank's decision is the key point. First of all, I don't bother to bring political developments into this analysis. I have already done two videos on that. Check the previous two videos. One about how Erdogan plans to kill Turkish democracy, and the other one how he crashed the Turkish lira. Essentially, probably mindful of even more massive protests on the streets, President Erdogan has paused on his plans to turn the main opposition party to a government-appointed trustee and to take over the Istanbul municipality, which is a huge source of rent for his cronies. But he hasn't given up on this idea. The moment streets calm down, which probably will happen over the summer months, he will pounce. Again, this video is not about politics, so I'm just going to give my conclusion that from the perspective of financial stability, political outlook is extremely dim. It is going to have a disruptive effect on financial stability and on investor sentiment. So the big question is whether the Central Bank of Turkey can hold the line. Of course, if Erdogan permits Economy Minister Mehmet Şimşek to pass a decent tax reform, which would cut the budget deficit, which is currently running at 5% of the GDP, that would also help lower inflation and eventually stabilize the Turkish lira. But I don't have much hope about that. So let's start with the post-mortem. As I've said, the arrest of Ekrem İmamoğlu on 19th of March, on the orders of Erdogan, let's be very clear about that, because the charges against him are completely BS, triggered massive street protests, first led by the main opposition party, CHP, which is still organizing them. But eventually, this have become endemic. Now, university students are leading wildcat street protests. And over the last 2 days, we have seen some high schools join the protest movement. So upheaval on the streets continue. This was obviously a huge shock for the foreign investors. They don't like this kind of political shocks. They bailed out immediately. Most of them were never convinced by the Turkish story anyhow, because Erdogan is as unpredictable as Trump. And they said better safe than sorry and took their money out of Turkey. Turkish deposit holders followed them, worried that this is the end of Turkish democracy and street protests could turn ugly, could turn into street clashes. So they started migrating to FX deposits. That part, if you follow the international press, you'll be familiar with. But there were three more shocks. A, the global backdrop suddenly deteriorated. Emerging markets experienced an exodus of financial capital too. Now, if you look at the emerging markets data, you will see, because the dollar index is dropping, emerging markets currencies gaining in value. A lot of loose talk about how their central banks can cut interest rates, and at times of such turmoil, emerging markets are the best safe haven. It doesn't work like that. And I've followed International Institute for Finance data, as well as various other sources which look at the composition of emerging markets exchange traded funds. Both suggest outflows, mainly from China, but from, all over the emerging markets. So that too was a shock, which was an exogenous shock, but it overlapped with the Ekrem İmamoğlu arrest and exacerbated the situation. There were other shocks. A very reliable female journalist, Miss Nuray Babacan, stated that former central bank governor Ms. Gaye Erkan will be promoted to the chairmanship of Presidential Investment Commission and eventually replace Mehmet Şimşek. Mehmet Şimşek is synonymous in Turkish with rational economic policies. And we do know that when she was in her post, Gaye Erkan and Mehmet Şimşek didn't get along very well. Moreover, Gaye Erkan is not as orthodox or hawkish as the current president of the central bank, Mr. Fatih Karahan. So people, thought, wow, I mean, if she's making a comeback, that's probably in preparation of a more important job, and she might eventually take Mehmet Şimşek's place, which led to another exodus. Finally, in its haste to help the Treasury meet its borrowing needs cheaply and not understanding the dynamics of the capital markets at all, Turkey's capital markets regulator, Capital Markets Board, decided overnight that money market funds ought to keep 10% of their net assets in government bonds. Now, money market funds are what they are. They invest into overnight assets. So they have no capital loss proposition. You invest into a money market fund, you earn a lower yield than a bond or equity fund, but in return, there is no way of making a loss. Turks have invested roughly $40 billion into these money market funds, which were yielding fairly well. And one morning they woke up and their funds were losing value. It's called breaking the buck in American slang. That was a huge shock. They withdrew half the cash, $20 billion out of that 40, and most of it went to FX deposits. Um, so all of these shocks reverberated and reinforced each other. And at the end of the day, according to the central bank balance sheet as of last Friday, $40 billion left the country. Central bank's net FX reserves declined from roughly $55 billion to $15 billion, though its gross reserves are still ample at roughly $150 billion or so. Okay? Now, clearly, even if the political shocks were to continue, staying in FX is extremely costly for a Turkish depositor. FX deposits don't yield any interest, whereas for small investors like me, one can earn at least 3.5% per month net. In money market funds and in private banking structures, instruments, one can earn 4.5% per month. So there's a huge yield difference. I'm really sorry. This is called the pain trade. Every month you wait in FX deposits hoping Turkish lira will crash. You are losing at least 3.5%. Clearly, people will not remain in FX deposits for a very long time unless there is another huge political shock or the central bank makes the mistakes of cutting interest rates. And this brings us to today. Thursday, as I've said, Central Bank Monetary Policy Committee will announce its interest rate decision. According to several surveys, it's not expected to cut rates. This should stop the migration of Turkish depositors from TL to FX. Why? It doesn't change the yield difference. Because by starting its monetary loosening cycle too early in last December, central bank gave the impression that it's really not interested in reducing inflation, but protecting economic growth and pleasing its master, Mr. Erdogan. Now, when inflation trends are clearly not getting better, another rate cut would simply be interpreted as Erdogan once again ruling monetary policy behind the scenes. That means central bank will be forced to cut interest rates at each meeting, which reduces the expected cost of staying in FX deposits. Clearly, if the value of the currency is artificially determined by central bank intervention and central banks keeps cutting interest rates, at some point it's going to run out of reserves. The faster it cuts interest rates, the sooner that breaking point will come, which means that it's less costly to wait in FX deposits, hoping to benefit from a crash of Turkish lira. Because when that happens, central bank will be forced to raise interest rates and the dollar will rise. You will use your dollars to buy Turkish lira on the cheap and benefit from high interest rates. It's as simple. If the central bank doesn't cut rates, it would partially dispel the suspicion that Erdogan is running interest rates or that the central bank has been ordered to cut interest rates, which means that Turkish lira deposits will yield much higher than FX deposits for the foreseeable future. That should stop the tide. There is another factor or two factors that work to the advantage of the central bank. As you know, Turkey is a huge importer of energy products and plastics. Sorry. So as oil prices decline, Turkey's current account deficit and inflation should decline as well. Secondly, tourism season. It starts in late May, but between, say, June and October, Turkey generates roughly $40 billion of net income from tourist flows. And that will fill central bank's coffers, and it will give the central bank ammunition to control the pace of currency depreciation. But again, 4 months is not a very long time. If the end of that game is a currency crash, say in October or November, a lot of Turkish depositors will take the risk of waiting in FX deposits, knowing that the politics will get worse. And, after a summer lull, central bank reserves will decline very rapidly. In the meantime, since central bank is cutting interest rates, inflation is not going to improve. So this is the ugliest scenario. If central bank doesn't cut rates, I don't think Turkish retailers uh, will spend summer in FX assets. They will return to Turkish lira at least through October, and then check the situation to see if they should stay in TL deposits. Of course, I wouldn't rule out an interest rate increase, though it's not very likely. That would, in my view, completely abolish the possibility of a currency crisis because foreign investors will also return to Turkey. Now imagine the situation. You have a fairly yielding asset. You know how the currency will behave, so you're hedged against unforeseen currency shocks, and this is essentially called carry trade. You borrow in dollar or Japanese yen, you buy options to reduce your currency risk or hedge yourself against currency risk, and you buy into Turkish lira assets. It's a simple math calculation. If the net result is positive, then you will make money. And an interest rate increase would very strongly signal to the international investment community that Erdogan doesn't really care about interest rates anymore. The central bank is free and independent in stemming financial stability risks and perhaps even fighting inflation. At a time when the whole emerging markets universe is in turmoil because of Trump's uh, tariff decisions that change every day, Turkey becomes a safe haven. So by the time you watch this video, the fate of Turkish financial system will be determined. I don't think interest rates will be increased, but even central bank holding interest rates steady would be sufficient to defer this whole ugly topic of a financial crisis until the winter months. I just thought you should know. Thank you very much for watching my channel and for your comments, which are an endless source of joy for me. I do read them all, but since, as you can, imagine, business is very heavy nowadays. I haven't really time to respond to them, but I shall do so at the first opportunity. Stay healthy, stay cool. This is Atilla Yesilada saying goodbye from Istanbul.